In this video, guys, we're going to look at the pitfalls of technical analysis and is it scientifically sound? Stay tuned. Hey traders, a very warm welcome to you. Okay, so if you've been watching this channel, thank you for your views, thank you for your subscription. If you haven't yet, consider doing so. But you will know that I like charts, but I also like to look at them in the context of where they are. Let me explain. And this is where I think that technical analysis goes wrong, and where the pitfalls of it are. Why people say, hey, it's not working, it's not working, it's not working. I think they're missing the point. Let me explain. Okay. So I've got a few things here, and normally I go through each list, but I think these are all very, very similar. So I'm going to wrap them all in one and then explain my theory behind this. Right. So the catalysts, what do I mean by catalysts? So catalysts are what is causing the market to move. Just bear that in mind. We'll move on to the next one. Market environment is the conditions of the market, i.e. where are we with the economy? What's the kind of news flow? What's the macro situation? You know, where are we with the whole thing? Where's the market doing? Are we kind of coming out of recession? Are we kind of running at the end of a bull market? Are we worried about this? Are we worried about that? That's something to think about. Next one is trader sentiment. How are traders perceiving things at the moment? That depends an awful lot on what's going on in the market. And again, come back to in a second. And the participants in the market. Okay, right. So we've gone through those. Let me explain why I think technical analysis is no good under certain conditions, and why it's very useful under other conditions, and why people are missing the whole point with it. Now, do I believe you can have a chart pattern, plug it in, and it shows success for the whole of time? No. In actual fact, many times, actually, these are people who are naysayers against technical analysis, and these are the guys I think who are missing the point. They'll plug in a head and shoulders, or they'll plug in some candlestick pattern, they'll back test it over many years, they'll get mixed results, and they go, there you go, it's proof it doesn't work. You're missing the whole point of how you use technical analysis. Technical analysis, all it does is it's taking a little bit of history, i.e. the last day, the last week, the last year, whatever time frame you're looking at, and using that as a potential predictor of what could happen in the future. But it's just a piece of the puzzle. This is the thing that people get wrong. It's a piece of the puzzle. You need to know what's the catalyst for it. I could have a chart that does this. It's going up, 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 up. It's pulling back, right? That is one chart pattern. It's a pullback in a chart, or it's a flag, or we could say it's a flag. It could be exactly the same thing, but the reason this kicked off could be completely different. The reason that kicked off could change the way that people perceive this move. So if the catalyst is earnings in a stock has suddenly turned a corner, it looked like they were going bankrupt, I'm using extreme here, and now they've suddenly pulled out all the stops, they've got a new strategy in play, it worked really well for that quarter, it looks like they're turning the corner, that thing is probably likely to push back higher. You've probably got shorts in it, you've got new fresh longs getting involved in it. It's a different thing to, let's just say it's broken out of a 2-month high. Still reasonably technically valid, but there's no underlying catalyst. It might have just done it purely from technical. There's no news, there's nothing underlying pushing it. It's just people seeing it on a chart, believing its value. So different examples there, but you kind of get the point. Maybe legislation changes that makes this such more attractive thing. Maybe, you know, there's a court case that's been won that changes the dynamics of this company for the next 20 years. There's always a catalyst. Maybe there's some sort of shortage in a commodity. Maybe there's a harvest issue or something. You know, there's always something that is going to affect it of a more of a magnitude than just using that purely from a chart perspective. Oh, it's broken out. Yeah, that's great, but let's put it into the context. Same with the market environment. The market environment is so crucial. Are traders nervous? Because don't forget, we always think people want to make money. That's not everybody's goal, as crazy as it sounds. We want to make money short term as traders. Some guys might want to park money for dividends. Some guys might want to just park money because they've been given it. Hey, a mutual fund or whatever, I've got a massive inflow, I've got to put it to work regardless of what this is showing me. You know, this might be a pushing to the downside heavily, but if my fund has allocated 0.2% of assets to it and I suddenly have an inflow, I've got to buy it, and my buying might cause it to push up. So you can't look at it, you have to look at it in a bigger picture. The market environment might be one of fear. You know, guys might be worried about their hedge fund going under, in which case they will be very quick to take profits here on a poor trade that's suddenly given them a little bit of a boost because they're worried about a position they're offside on further down the line, or some sort of trade that's not doing so well. Motivations are all very different, and technical analysis relies on us making a big assumption that everyone's motivations are the same, and they're not always the same. We behave irrationally, even going down to the retail level like you and I trading. Very often, you know, we might take profits early because we're worried about another position that's even on our small little portfolio or small little book. We might be saying, I'm worried about that position. I can't be managing that when I'm going to come out of it. So imagine you can't even predict on a low level, let alone a high level sometimes. So understanding the market environment, is it positive? Is it bullish? Is the whole trend of the line good? Is the economy good? Is the news flow good? Are people making money? Is everyone happy? That's far different to the market environment of there's concerns. You know, one of this sector's going under, that sector's struggling. You know, a couple of funds are doing this. There's a different changing dynamic. And I could go on and on about it, but I'm not going to. I think you kind of get the point on that one. Trader sentiment, very, very similar, but also surrounding the chart that you're looking at. Technical analysis, you know, makes a big difference on what the sentiment of the stock or the market or the commodity is. If everyone's super, super bullish, you could have the most bearish chart pattern ever that everyone says is the best bearish chart pattern ever. It doesn't matter if the underlying sentiment is strong. People don't see it as a push to the downside momentum play on a pullback, a bear flag. They see it as a basing level to buy for a push to highs. You know, it's how people view things, and you know yourself, you tend to view things with your own lens on, your own lens. You put your own lens on things with trading. So why would it be any different if you've got a massive amount of participants? They're all looking at a chart pattern completely differently. Now the point is, when we can line things up and we can say, hey, sentiment is bullish, sentiment is strong, market environment is good, is a positive catalyst, and we get our technical analysis pattern that's reasonably bullish, now we can see, put things together, now we've got more of an opportunity, and that's when our technical analysis comes in, because we have the reason to go long. The technical analysis gives us the entry and quantifies our risk. It gives us a place to get long, waiting for that pullback, waiting for the oversold on the indicator, whatever it may be. It's that gives us then the trigger to pull it. This is kind of the filter, that's the trigger. Using that as the filter and the trigger is a risky play. All right, and the final thing is the participants. And this is a big one, guys. Let me rub this off. Imagine the participants. I want you to think about the participants in, let's say, Boeing as opposed to Bitcoin, right? Two similar charts. You could have exactly the same chart, right? Up it goes, and we use the same kind of thing, pulls back, and then it goes again. You've got Bitcoin and you've got Boeing, or you've got McDonald's and you've got Bitcoin. Just think of a big blue chip company, okay? And then you've got something like Bitcoin, or you've got some sort of high-risk pharmaceutical biotech company, right? I'm putting those in the same kind of category. The participants in those are completely different. You've got in the big blue chip stuff, people who are buying it for 20 years, 40 years, 50 years, for pension funds, for dividends, for stacking away cash, for investments, as part of a bigger, broader strategy. There's loads of different reasons why people are buying that. There are some people, obviously short-term traders, looking for a short-term gain on it, but that's not the majority of the people in that stock. They're not generally the reason that people are in that stock. However, if you look at Bitcoin, you look at something that's very, very volatile, little liquidity, not much participants from big players, i.e. big hedge funds, big money. I know there are times when money does flow in, but generally speaking, the people involved in it have different motivations. And so you might have exactly the same chart, but the difference is the participants of this are looking for a quick buck. They're in Bitcoin or in something, they're looking to make money quickly. Of course, there are people who believe, there's always a small section that believe it's got long-term value, whether we're talking Bitcoin or we're talking a pharmaceutical company or something that's suddenly ripped off. There's always going to be those. But the reason for this rip is that new speculators are coming in looking for quick money. Now, of course, you get the first pullback, it pushes up. Now it starts to pull back aggressively from the highs. Compare this, Boeing to Bitcoin, we'll use that same example. That really doesn't matter to any investor. No one cares at all. The majority of people who are in that stock don't care about that pulling back. They're just in it. They're in it for whatever reason. They've got a long-term view on it. They're not price sensitive at all. Whereas people who are speculating short-term, whether that be Bitcoin, whether that be our little biotech company that's just gone crazy, whatever it may be, are very sensitive to that. If they bought there and they've seen themselves get a 25% haircut, whatever it may be, they're out of it. They're not in it. They don't care what it's going to do in the next 10 years. They're just looking for quick money. So that changes what might happen here. A big stock might start to base a little bit, might start to just calm down, relax. A smaller stock or a crypto or something is going to fall through the floor because all the participants have got different kind of goals for it. They're much more price sensitive. They're much more concerned about that. They're just seen, they put all their money into it. They've just seen 25% haircut. They have fear of losing it all. They've pulled it out. So that could be exactly the same chart pattern, exactly the same technical analysis, exactly the same combination. I could put anything up here, indicators, all sorts of stuff. But the point is, these guys are different, which is going to give us a different outcome, or potentially give us a different outcome with that chart pattern. So going back to the initial point, is it scientifically sound? What are the pitfalls? In my opinion, you've got to combine some kind of fundamentals with your chart. You can't just look at the chart. You have to see what all these things are doing. What are the catalysts for it, if there are any? What's the market environment? What's the trader sentiment? And who are the participants in it? And before I've talked about, I don't want to go into this video because we'll be here for ages, but even things like, okay, what's the broader chart looking like? What's the daily? What's the weekly? What's the longer time frame? Where does that little chart pattern fit in with the broader kind of feel of the market? And that does come in a little bit with the environment and sentiment, but even from a technical perspective, where does it fit in? So watch out for that, guys. Technical analysis is very, very powerful, very, very useful, but just remember where it is. Watch out for those pitfalls and just be cautious of how you use it. And when you hear lots of people saying it doesn't work, doesn't work, doesn't work, then just say, hey, have you thought about maybe combining it with some sort of underlying structure and thinking about who's involved in it and who's playing the game as opposed to just numbers and patterns on a screen. All right, guys, take care. See you next one. Thumbs up if you like this kind of stuff. Appreciate it. See you soon. Bye-bye.